Welcome everybody to the October market update. We're at the point now we're on pins and needles waiting for the next market update, aren't we? I'm Cindy Bishop with Cindy Bishop Worldwide, and I want to introduce our speaker today. The topic for today is our monthly market update, which has become extremely valuable to us, which we started at the beginning of COVID. This update has become a very popular and useful for agents. I think you can all agree many of you are repeat players. This market update is important for all of us because it anchors where the real estate market is today, is currently, with all of the updates that Jolene gives us, and interest rates and the whys and the hows. This information is crucial for you as real estate agents to help you navigate your market. Our speaker, Jolene Moore, is a top producing lender. Her knowledge of market intricacies as well as her attention to detail cause her to be one of the best authorities on this topic. Jolene has an abundance of experience and a keen ability in the real estate lending field. She is not only a top producing lender nationwide, she is also a vice president and senior home loan consultant with Main Street Home Loans there in Fairfax. She is also a very well respected and sought after trainer with Cindy Bishop Worldwide. And I hope Jolene remembers to tell you what her upcoming in-person event is before we're done. Please welcome Jolene Moore, your presenter for today.
Thank you, Cindy. Thanks, everyone. Sorry for the little bit of delay, but like we've said in the past, I'll have my chat box up. So if anyone has any questions or any comments, please feel free to unmute yourself or put it in the chat because I love interaction. All right, so we're going to get, to it. Can you see the chat box when in my share screen? No? Okay.
I can see it. Who can't see it?
I just want to make sure I wasn't blocking anything if I had that up.
Yeah, I see it.
Okay. All right. So market information. So this is where I kind of just share things that are happening, within the market, kind of outside of just lending, but just real estate market. So and I always kind of do some research leading up to it just to share some things that I have seen that I think can be of value to you. So private and public construction spending was up year over year. So even with what we've been seeing with the market and challenges and all of that, people are still investing in renovations and things like that. So that's one thing I think that we're looking at doing, like a class soon on renovation loans. But I think that that's something that could become a little bit more popular or more relevant in the market that we're in and going to continue in for the next several months. Because if you have a property that, isn't pristine, like we've been talking about in the past, where there's some things that need to be updated, and so it might be causing it to not move as well, that we want to do some marketing relative to renovations, loans, things like that could potentially help you sell that listing, and prevent some challenges or having to reduce sales prices and all that kind of stuff, price reductions. So that's some things that we can definitely are going to be working on. If you have any questions on that, please reach out. Home sales were down 28%, which we all know the market has definitely slowed down. So we're almost 29% down from July of last year to this year in just numbers, the amount of units that were sold. And then new listings were also, down. So we're seeing, inventory grow, but it's still lower than where we were as of last year, about 17%. The one thing I noticed that was I wanted to point out was if you look at January's or July's average sales price versus August average sales price, there was a decline of about 7%. I was talking to some agents yesterday because I always try to get a pulse of the market and kind of what everyone is experiencing. It seems kind of like there's kind of all over the map. There's some that saw a house price. One of them was telling me how she had a house that was listed initially for $800. They lowered the sales price several times to where her buyer ended up getting it, I think, for like $680, and it ended up appraising for $840. So it wasn't that it was overpriced, but potentially overpriced based on our current market, but the comps were there to support it. But I've also have several clients. I have one right now that's doing a renovate that's going to be ratifying today, and it's a relocation, and they escalated over sales price. Now, again, all of these could be different factors. I asked her about the one that was really, had come down quite a bit. Was there anything wrong with it? She said it wasn't great, but it wasn't, meaning it needed some updates, but it wasn't like, a totally rundown type place. So It's definitely, property specific, can be even community, specific as well. So it's going to be interesting. There is a prediction that we could see, 5, 10, 12% reduction in values. So I don't think that there's, anything that's saying that we're expecting to stay flat. But I do think that there's going to be some, some correction from what we've experienced the past 2 years. But what I will also say is if you look at our increase from 2019 to current, we increased about 18%, whereas there's other markets in the country that increased 30, 40%. So we shouldn't see as much correction as maybe some of the rest of the country will, because we didn't see as much of a growth. Now ours feels like more because of our sales price point. We're obviously at a high price point compared to a lot of the country. So that is, it hits our checkbook a lot faster, our wallet, a lot harder. But those are just some things to keep in mind. Year-to-date homes sold is lower by about 16%. So again, that's units of the amount of homes that have actually sold year-to-date are down 16% from this time last year. Which again, that last year, I think in most terms would be one of the best years that most everyone has had. So to be down 16% is not massive, but it's obviously challenging and creating some opportunities that we need to be doing more marketing, more touch points, more conversations, more meetings, all of that to close that gap between the shift in the market that we're seeing. With the listings down, home sales were down 3% from August to September as well. Or actually that was July to August, sorry. Cash sales were staying pretty consistent. So we're staying right around 15%, VA loans about 11%. So not a big difference there in what we're seeing. And then, so it says, Maggie's saying, what area are you reporting? Most of this is Northern Virginia. Realtor Association is where I'm getting most of this data. Some of it is national, but most of all these numbers are coming from the Northern Virginia Realtor Association is where I got this information. Okay, so lending information. We mentioned before 2-1 and 1 year buy downs that are available on conventional FHA, VA, and USDA. The one thing I will say is I definitely think it can be valuable. It can be helpful. Like if you're looking at, if you have a listing again that might be having some challenges in selling, you're looking at doing a price reduction, maybe instead offer a seller concession to either do an actual buy down or just points to buy their interest rate down. The one thing I have found with the buy down is we have to look at it long term. Is one, the rates are about 0.25% higher with the buy down. And then two, if they don't use all of the funds that we put aside into an escrow account for the buy down, they lose those funds. So obviously we don't want anyone losing money. So what I've been having conversations about with clients more is buying the rate down permanently. Like we have a client right now, we locked in yesterday at a 5-year ARM with 1 point, and that was significantly, it was more than a point, 1.25% lower in interest rate than the 30-year fixed. So and that's going to be a permanent buy down, permanent lower interest rate for 7 years. So the buy down, I think, can be great. I've used it with some agents to help them market their listing if they're having some challenges with the listing. Rather than just doing a price reduction, we can do some things like that. But it's not going to be something I think that I'm going to widely use, because again, with anticipation that rates could come down in a couple of years, in a year and a half, potentially, or a year, we don't want anyone losing rates, any money. And as I was afraid, this computer is getting ready to die. So I'm going to have to switch to my other one. But I just remembered that I didn't go over interest rates. Somehow I skipped this thing. So I wanted to go back to the market. So we all know over the past month since I did this market update, it's crazy what interest rates have done. I mean, literally, I think from a Friday to a Monday, the market jumped up almost, I want to say, 1/2 to 3/4 in interest rate. And the rest of that week, we probably went up a full percent. So we've definitely seen a lot of volatility with interest rates. A lot of it has to do with inflation numbers. They came out much stronger a few weeks ago than what was expected, and then the market reacted. As you all know, the Feds also met last 2 weeks ago. They raised their rate, or actually might have just been last week. It's hard to keep up this straight. Last week, they raised their rate 0.75%. Again, the market was already anticipating that. So we don't, follow a direct line that we went up 0.75%. but nonetheless, we saw some volatility associated with it. Now, this week, we've started out better. Yesterday and today, the market has actually been improving slightly because of some other inflation number report came out yesterday that was a bit more in line with what they were hoping and lower than what was expected. And then the England Central Bank is also proposing tax cuts, and there's a lot of things going on in their economy that is impacting, because when other markets globally are challenged, a lot of times the money flows into the US and into our bond market, and the bond market is what controls our long-term interest rates. So we saw yesterday, because of that, we've seen some improvement in rates. Now, the thing I will always say is that when the market worsens, they take it a lot faster than they give it back. So unfortunately, we've seen a good in price improvement, but we haven't really seen that as much in the interest rates. So I think it will take a little time for the rates to kind of catch up and for the market to feel confident that that might be the direction that it's going. So we'll see kind of as that goes in the week. So because of that, we're still in the high sixes. There are ARM products, that are still in the fives. So there's still opportunities to get a little bit lower interest rate than what the 30-year fixed is. Now, again, Fannie Mae, I think almost every economist, every article that you're going to read, the expectation is that interest rates are probably going to come down next year. Now, to what point that comes down to, Fannie said 4.5 range. Others I've heard low fives, high fours. We don't know. But the reality is that's why like that buy down might not be the best option, because we don't want somebody able to refinance next year and not doing it because they have money still left in an escrow account that they're not using. So that's where we're going to have to kind of see, what happens. But those are conversations that I'm having and trying to provide, financial education to help them understand, here's what the potential is. And we want to help set you up so you can take advantage of that when that happens down the road. So anyone have any questions while I switch to my other computer here?
Jolene,
Yes.
what's the difference between a buy down and paying points to lower the interest rate permanently, like you mentioned within the ARM?
The buy down. Am I echoing to you guys? No? Okay. Hold on just one second. All right, sorry a minute. The buy down. Oh my gosh. I'm reverting myself. Okay, can you guys still hear me?
We can hear you and we don't see a screen other than pictures.
Okay, can you hear me now?
Yes.
Okay, so the buy down, John, what that means is the buy down is the buy down is either for a short period of time. So it's either 2 years or 1 year, which means that you're buying that interest rate down for just that period of time. Whereas when you're paying points, you're buying it down permanently as long as you have that loan. So like if you're doing a 30-year fixed, you're buying it down for the 30 years, right? Or if you're doing an ARM, you're buying it down for the period of time that it's fixed for that ARM. So it could be 7 years or 10 years, which is the normal ARMs that I tend to do. So that's where the difference is that a buy down term is very temporary, and it's usually only for 1 or 2 years. Whereas when you're paid points, it's going to be for a much longer period of time. That makes sense?
It does. What's the price differences?
It's all dependent. It depends on the loan amount, depends on credit score, interest rates. There's so many things. And that's the hard thing about points is there's no set like, okay, you pay 1 percentage point and it gets you a 1/4 point lower in rate or 0.5%. Unfortunately, it's all dependent on the market that day, how each rate is priced. Like for instance, right now, what we're running into is the market does not, it knows that the prediction is that rates are going to come down, right? So there are certain products like with low credit scores, 15-year fixed, things like that. The market doesn't want the investors are not really wanting those loans because they know they're going to roll off their books. Basically, people are going to refinance those. So any money they pay to get those loans, they're going to lose. So it's a challenge right now to try for investors as well to figure out what loans do they want. And that's why our pricing is so up and down and volatile because day to day I could get you a 0.5% for 1 point, or another day it might only give me 1/8% for 1 point for 1% loan amount of, to cost to buy that rate down. So there's not a given, unfortunately, in our market in order for us to know that. So it's all on a case by case basis.
So it makes sense, but I was thinking more in the way of a permanent point buy down versus the 2/1 reductions. Is the 2/1 going to be lower to do the same
No.
amount for the 2 years?
No, it'd be more. So if you do like a 2/1 buy down, the average right now cost to do a 2/1 buy down is about 2.3% of the loan amount. So it's, in many scenarios, it could be $15,000, $16,000 is what it's cost to do that 2/1 buy down. If you do 1 year buy down, it's a little less than 1%, like 0.8% of the loan amount. Whereas a point could be 1% of the loan amount. But there are lenders out, like I had a client get a quote yesterday to buy the rate down, like to do pay points to get the rate down permanently. And they quoted him 3%, which was $19,000 of points. I would not recommend paying $19,000 in points. And for a lot of that is the factor, what we just talked about, is that the market's going to adjust in the next year or two. And when I say that, why I'm saying that is because if you look at historically, what the feds are doing right now is they're raising their rate because they're trying to push inflation down. And when they do that, our rates follow, right? Because when our rates go up, not in the same, exact trajectory, but meaning same exact number, but we're still moving up. So when they finally hit their threshold of what they feel like, okay, we've taken our rate high enough, the feds have, to push inflation down, then normally we are in a recession, and following after that recession, then mortgage rates come down. So if you look at historically speaking, it's over many, many years, past 40 years, that's what's happened. So that's why we're all anticipating that that's what's going to happen next year, because of what the feds are having to do, and which is what's creating our interest rates to go up as fast as they are. Okay, Cindy, for some reason, it's not letting me share my screen on this new computer. So Kaylee had this question: with the possibility of rates lowering next year, wouldn't a 1 year buy down make sense?
Jolene,
Correct.
my security is up, so there's nothing else I can do on this end. It is in the right place, like I always do, where you have to hit that in order for you to share your screen. So all you can do is hit share screen.
Oh, well, maybe it's working now. So
Okay,
I'm not
there.
sure.
Great.
Yeah, I'm sorry. I don't know what happened. Kaylee, that's exactly what I would recommend. Exactly what you just said is, I would say the 1 year makes more sense than the 2 year, because of the fact that interest rates could come down. So I agree with you there. Okay, so interest rates. Anyone else have any questions on interest rates and kind of what's happening with the market? Does anyone feel like that gives them a good? I mean, and honestly, one of the things that, and I'm sure you guys are doing this, or I hope you are, is I listen to video almost every day of some type of education, of teaching myself either things that I can do to help my clients or help educate the clients. And I think something I heard today is really spot on, is I think you all have to dedicate a certain amount of time every morning to educate yourself on what's happening with the market, and we're talking about the numbers I just shared, I'm sharing here, talk to a lender about interest rates, but really, look at articles. There's a great website called Mortgage News Daily. And they have, that will help you track where the interest rates are going, like what's happening with the market. It will also give you a lot of articles about what's happening with the market. So a lot of the data I get is from Mortgage News Daily. And then the Northern Virginia Real Estate Association. I know there's other real estate associations around here too. They have information. So anything you can do to educate yourself, but also stay in a positive mindset, and that's, I think, a challenge for all of us right now, because of the shift that we've seen and the changes that happen so quickly that we all have to adjust to it now. And we all have to think about, how do we move forward from here? How do we educate our clients? How do we help them feel comfortable in moving forward and purchasing? And I think I've said this many times, I've done a lot of videos on it, but there's challenges and opportunities in every market. And in right now, the opportunity for first-time home buyers especially, but just a lot of buyers, is that they may not have to escalate. They may get seller concession. They may get to keep all their contingencies, you know, and I know it's case by case. It's not all in every situation that's the case, but it's a lot more than we saw in the past 2.5 years. So the one challenge right now is interest rates, right? So if we can get their mind off the, you know, and obviously there are some people that just can't afford it with the current interest rates, but if they can, and they could get into a home now without having to pay more and be able to have to waive all these contingencies, it's a great time for them to take advantage of this and then be able to look at refinancing a year or two from now. So it's really a way that we have to educate our clients to help them understand that. All right. Let's see. So John said oh, you already said, okay. All right, so let's go. We talked about the 2-1 buy down. So recently, something that happened that was beneficial, especially for people that have little tight debt to income ratios or maybe not the best credit score in the world. We are now able to use rental income, not rental income, rental that they've paid. I have that in there wrong, so I'll correct that. It means rental history. So if they're paying rent right now and they're looking at buying a home, we can now put, like, if they pay it from their bank account, we can pull their bank account information and put it within the automated underwriting system so that they use that when they're looking at should that automated underwriting system provide an approved eligible, meaning they will allow this loan to close and they're going to purchase this on the back end and insure it. This is Fannie Mae, Freddie Mac, you know, HUD, all of that. They now allow us to use rental history to benefit from in that underwriting system. So Fannie and Freddie have been doing it. Fannie was the first, then Freddie added it. Now FHA has added it. So we had a great success with this a few months ago. We had this bar, we could not get through the underwriting system. Their DTI was not, it was like 45, little over. And they had good credit and all of that. And we're like, what in the heck? We can't get this to get approved. We added their rental history that they'd been paying rent, got it approved. So it definitely can be beneficial. So if you have clients, you know, let them make sure that they're letting their lenders know that they have good rental history and that and if you have clients that maybe are renting now and they're going to prepare to buy in a year, tell them to make sure that they're paying the rent out of their bank account, because when they do that, then that's going to allow us to track that a lot easier. So don't pay it out of Zillow or Venmo or, you know, all those things a lot of people do. If we can do it where it shows that the landlord's being paid from their bank account, it's going to help us potentially if things get tight. Increasing in conforming loan limit. So right now our conforming loan limit is 647,200. There's anticipation at the end of the year. Fannie and Freddie usually announce that in the November timeframe. That they're going to obviously be increasing that because of the increase of sales, you know, average sales prices that we've seen. So for right now, as a temporary, we're increasing that to 715. Last year, we did the same thing. We went up and it ended up going higher than what we even anticipated. So there's a good chance it could go above 715 when they make their final announcement. But for now, any loan that we do that falls 715,000 and below, it's going to be considered conforming, which is going to be the best interest rates most of the time out there. So that's a benefit right now for clients. And that, you know, like I said, that will be announced the final number sometime in November. There's doctor's program, DSCR, which is, you know, if you have clients that are thinking about doing a hard money loan, you know, for investment property, the DSCR loan is a great alternative to that. Because basically it's just a cash flow program. It's basically looking to say, does the rental income carry? Does the rental income enough to oh my gosh, I can't use my words. Does the rental income you receive, is it more than the mortgage payment? And if it is, then you qualify. You don't have the debt to income ratios and all of that to worry about. So it can be a great alternative when people are looking at hard money loans, because if you've done any of those, you know those rates are pretty darn high and they have a good amount of points. So the rates on this are still high, but they're not as high as what you see on most hard money loans. So it's a great alternative for that. Bank statement programs are coming back, which means this is only for self-employed borrowers. It means that, you know, if they have all their money coming into their bank account, then they write it all off at the end of the year. So we don't have enough income to qualify. we could look at using just their bank statements and calculating the income that they've received, they've deposited into that account for qualifying purposes. Now, again, that's a unique product. So the rates are going to be higher than the market rate. But if that's the only way someone might be able to qualify, it's a great alternative so that they can still have the ability to purchase a home, which these programs were back in the day, we had them. But I will tell you, they're coming back, but they're coming back with more restrictions, more guidelines. There's more, the bank statement program in the past could be used by anyone. It can now only be used by self-employed borrowers. So there's a lot of restrictions to it. So, because I know a lot of people, when I talk about this, are like, oh my gosh, we're going back to 08, or 05, 06. That's not the case, because a lot of these have a lot more restrictions, the guidelines associated with it than they did back then. And then bridge loans. We have a bridge loan, which most everyone knows, it's on their current property, being able to pull equity out of that home to be able to use them for the down payment on the new home. We also have a lender, one of our investors, that will do what's called cross collateralization, which means we're using two properties, the property they're purchasing plus the property they own, looking at the total values. And I had a situation with a client who was buying, a $1.9 million home, hardly owed anything on their current house. We didn't have to do a bridge loan. We were able to do what's called a cross collateralization, to where that they basically put liens on both properties. It's a whole thing, but it allowed them basically to qualify without bringing any money to closing except for closing costs. So there's a lot of new products out there that if you have anyone, we're doing everything we can to try and find a loan product for every borrower, because we know every borrower is important in this current market. Not that they weren't before, but even more so now. So if there's anyone that you think has potential, reach out to us and we're happy to talk through and see if there's any program out there that could work for them. And then second homes, we have a new investor that does not have a hit to the rate for second homes, which it really hit the market hard last year when Fannie and Freddie made those changes. So if you have any clients that are considering buying a second home, again, we have them reach out, because we can help them with trying to avoid paying so much and higher an interest rate based on changes Fannie and Freddie made last year. All right, so debt service coverage ratio. Yeah, so Leslie was just telling everyone, what does DSCR stand for? So it's debt service coverage ratio. Basically, again, it's just what you can think of it as is a doctor or a cash flow. And like I said, it replaces hard money loans out there. And then the doctor's program is basically, and as it says, it's intended for the medical personnel. A lot of doctors, I've ran into this recently quite a bit, where there's doctors that coming out of residency or they're going into a new practice and they're going to get paid a salary for the first 2 years or the first year, and then their income's going to shift. In the lending world, we like to see a 3-year continuance of income. So when we know things are going to change, that can cause some challenges for us. But the doctor's program understands that, because they know, obviously the type of employee that it is and what the situation looks like with a lot of employers. So it allows really low down payments, potentially no MI, more flexibility with the way that a lot of doctors are paid now. So that's another program that's out there also. All right, and what is the name changes for the second home loans? The changes that happened last year that Fannie and Freddie made for second homes, they did this to investment properties and second homes. And basically they limited the amount of loans that they will purchase that are second homes and investment properties. And it was a pretty lean amount that they will purchase now. And because of that, it's caused investors, lenders like ourselves, to have to find other avenues for these loans, because only certain, and they'll limit the amount of loans that they'll purchase, but they also added a pretty large premium to those loans. So if they purchase those loans, they're going to charge you a lot more to purchase them than they did before, which means the rates went up significantly when they made that change to second homes. So we are in the constant, looking for new products and new investors who will basically do a second home or investment property without putting a huge hit to the rate, like Fannie and Freddie did last year when they made their changes. Anyone else have any questions? I like all these questions. Thank you very much. Makes it much more enjoyable. So I appreciate it. So again, always feel free to unmute yourself too, because I appreciate interaction in that way too. Okay, so let's go next screen. ARM products, again, ARMs have become very popular. And I would say the most popular ARM that I see is the 7-year and 10-year ARM, which means that, it's still amortized over 30 years, but the rates are either fixed for 7 or 10 years. And then that's when the loans can adjust. Now, what I will say is a lot of people, again, go back to fear mode of saying, oh my gosh, ARMs, they're bad, they're terrible, look what happened, back when the meltdown occurred. What I will tell you regarding ARMs is when when 08, 09, and 10 happened, and the value shifted, people were upside down, people were in ARMs and they were adjusting. A lot of people that were in ARMs, actually their rates adjusted lower, because when the economy is not doing well, as it was back then, the index that ARMs are connected to goes down. So when you start to readjust an ARM, you take what's called a margin. That's a preset, never changes, and the index. And the index is connected to the market. So it's either like a 1-year treasury index, something like that. And you take those, you add those two together, that's what becomes the rate when it starts to adjust after that fixed period of time. That when those were adjusting, those were actually going lower. So the ARMs were not the death of, and the cause of all evil back then. So I don't look at them as negatively as most people do. So I want to just kind of educate you a little bit on that. But two, also know that I'm more in favor of ARMs right now too, because the opportunity of refinancing. So take a lower interest rate right now, knowing that you're going to have the ability potentially to be able to refinance into a 30-year fixed in the next year or two. So when, the market that we're in right now, I think ARMs can be very favorable. Now, keep in mind that most investors who provide ARMs, they are going to be similar to jumbo loans, meaning there's going to be a lot more documentation, more restrictions, more guidelines, all of that. So if you have a client that's looking at doing an ARM, that's what they want to anticipate and expect, is it's going to be very similar to doing a jumbo loan. And I've talked about those in the past, but they cross every T and dot every I, and that's how our program is. So just keep that in mind. So if you have clients going their route and they're complaining, provide some guidance to them and help them understand what that looks like. Long-term disability income. So this is the section where I kind of talk about like things that happened last month for us and tips for you for transactions. I had a client who had been receiving long-term disability. So basically she'd been receiving disability income since she was young, very young. And it was basically a lifetime policy. So there was no end in sight. So we were able to use that income as qualifying income. When you have like short-term disability or workman's comp, things like that, that's considered short-term, meaning it's going to end. And if it is ending before 3 years, which again, is what we talked about, we like to see for continuance for income, we aren't able to use it as income. So that goes to alimony, child support, anything like that. One of our first questions is going to be, how long are you going to be receiving it? So if you're going to be receiving it beyond 3 years, then that can be considered stable income in our eyes. And then we can look at using it for qualifying purposes. So just, again, good things for you guys to know. Credit, this is something, we're pre-approving a lot of people right now who may not be looking at purchasing right at this moment and kind of waiting it out. I always let everyone know that credit is good for 120 days, which means if we don't close the loan before the 120-day mark, that's when we have to update the credit. So I think that can be helpful because that's 4 months. That gives, quite a bit of time to people. And I think that can, sometimes when I use that number, it will help kind of calm everybody to be like, okay, I have time. It's not like this high pressure situation. So again, I think that's some education that you guys can provide as well, that will help them feel comfortable and getting pre-approved to help them prepare, when they are ready to start looking. VA appraisals are coming back quickly. So we had a situation, and this is what made me think about the credit, is I had a client that I had pre-approved back in May. And he had started, his parents had encouraged him, talk to another lender, and he talked to another lender. And when they ran their credit, his credit score was about 80 points lower than what I ran it. And when I looked at it and I said, well, if we close by this date, was probably in about 2.5 weeks. I said, if we can close the purchase in 2.5 weeks, I won't have to rerun your credit and we'll be able to use the credit score that we got back in May. And we did it. We got it closed. We got the appraisal back. Everything went very smoothly, and we closed on the date that the credit was expiring. So there's things that, again, all of this works, in our favor. But what I will tell you is the follow-up in that was crucial, because if I hadn't continued to stay in touch with that client over that time period, I wouldn't have known that situation. I wouldn't have known that, he's now talking to, somebody else by encouragement of his family. I wouldn't have known, that he was now under contract and all of these factors. So it's like the follow-up for us, and I met with a client, an agent the other day, is we're talking about our follow-up for our team. But what I'll say to you all is never give up on anyone until it's done, right? So we continue to follow up, and I highly recommend in this climate that we're in right now, go back to people that you talked to last year, go back to people you talked to earlier this year that got frustrated, or that you put in rental properties. But if we don't follow up, I did a class last week, and there was a chart I've showed, and it's like, we're one of the most the most forgettable professions, mortgage and real estate, because they don't use us often enough to remember us. So we have to make sure they remember us. So you have to have the follow-up plan in place to make sure you're staying in front of everyone, to ensure that you're going to have those opportunities and that they don't forget you. Retirement income used right away, which means that we had this happen recently, someone was a teacher, they were retiring within that month, we were able to verify what their pension was going to be, and we were able to qualify them using that. Sorry, I'm going to get that off of here so you don't keep seeing it. We were able to qualify them using that income immediately. There's lots of different ways to use income nowadays, like asset depletion, which means, like I have a client right now who has a lot of assets, but doesn't have a lot of income coming in right now. We're going to use those assets as income without even depleting them, without taking money out of it. So there's ways for us to find income within different sources. It's just finding, a lender and talking to a lender to be able to have them have the whole picture, know exactly what that client's situation is, so that they can figure out what can they do for that client and help them be successful in purchasing a home. Anyone have any questions on any of this? All right, well, that is all I have today. So thanks, guys, and thanks for all of the moving parts of the computers and all that kind of stuff. I appreciate it. Again, if you guys ever have any questions, I say this all the time, but please use this as a resource. We'd love for you to reach out to us, ask us any questions. I also love to hear from you and what you guys are seeing in the market. So I'm trying to constantly reach out to agents to find out what they're experiencing. So if you see anything that is of, shifts in the market, I'd love for you to share those with me too, because, I'm trying to always make sure I'm providing them the best information I can.
Okay, so I got on just a little bit late, had a little trouble getting on. Were there any talk about any of the Virginia state loans or anything like that? Was there any loans in relation to?
You mean VHDA?
Yes,
Virginia
yes.
Housing Department? I did not touch on that, but I mean, we definitely do it, and that goes back to first-time home buyers. I think first-time home buyers are going to be a huge factor in this market and going forward. So I think this is a great opportunity for people to be able to use the VHDA loan, because they weren't able to for the past 2.5 years because of not having the money, 100% financing, things like that a lot of sellers viewed that negatively. So I definitely think that there's opportunity for first-time home buyers right now to be able to use that program.
Okay, my other question, thank you for that. The money, when the sellers markets was so prevalent, it just seemed like money was flowing, everything was cash, cash, cash. So I missed that part too. Is the money just as fluid with the young millennials as it was before? That's mostly who had the money, or those who were investors?
You mean the cash, it doesn't look like our cash sales have shifted much in this market. I think the past couple of years, it's been 11, 12%. We're now at 15%. A good amount of first-time home buyers that I talk to do have savings. There's not, and some of them have more obviously than others. But a lot of them have started retirement accounts. They've been, potentially living at home and saving. So there's a good amount of them, I find, and you guys obviously can tell me differently, that have funds, at least, because the thing is the minimum down payment for a regular conventional loan is 3%. So if we can go that route versus VHDA, it's more ideal for them because the rate's better and their purchasing power is greater. VHDA has higher interest rates and lower debt to income ratio guidelines. So their purchasing power can be less. And right now with affordability and all of that, that's what can be challenging with the VHDA loan. So I'm always going to talk to a client and say, what assets do you have? Do you have availability to get a gift? Do you have a retirement account you can borrow from? Do you have any liquid savings? So we can identify exactly what they have. So then we know what program they would be best aligned with. Based on that. The other thing too right now is with the fact of being able to potentially getting a seller credit from sellers, you could potentially get a credit to cover closing costs and all they have to do is down payment or, so there's ways to reduce that cash needed right now too, without even having to do the VHDA program.
Good stuff. Okay. I appreciate that. That's good. Now, being a listing agent, one other thing, what you're looking at, you mentioned the 2-to-1 buy downs. What should an agent who's on the listing side, when you got a buyer and you've got other buyers coming in too, should you watch out for? Because I do inquire about how their loan is coming through. Which ones?
The buy down can only be financed by the seller or the builder. So you're going to know if they're going to be doing a buy down because they're going to have to ask for a seller concession from the seller in order to do that. So so you won't have to, you'll know. I mean, really the financing, the loan process is not any different for a buy down than it is any other type of situation. The only fact is they're going to have to ask for a seller concession in order to finance that buy down. It can't come from them and it can't come from the lender. It has to come from a builder or a seller. But I have had agents using the buy down as a marketing tool on listings because that's a great way. Instead of lowering your sales price $25,000, you could instead give a $15,000, $16,000 seller credit to do a buy down or buy down the rate and save your seller money. So that's one thing to keep in mind too.
That's exactly what I was asking. Thank you. Incredible. Thank you.
Okay, you're welcome. All right, thank you all. Have a great rest of the day.